In this session then, we're going to have a go at an example applying the principles and concepts that we saw in the earlier two recordings for this chapter. So we're going to apply all our knowledge from the consolidated statement of financial position pro forma that we saw in the previous session, and also applying that idea of substance over form and the single entity principle as well. So let's have a look at this example then. It says, the following are summarised statements of financial position as at the 31st December 2011. And we can see then that we have two company sets of financial statements that we have. We have the parent statement of financial position and company S's statement of financial as well, so company P and company S. Can we see then under non-current assets we have some property, plant and equipment for P and for S. We also have some investments that P has made. Now we don't know what those investments are just yet, but we can see that $450,000 would be the cost of those investments that P made. We then have some current assets, inventory, receivables and bank for both of those companies. Further down then we can see under equity, the par value of the share capital or equity shares is $1 each, and then we have retained earnings for both of those companies. Under non-current liabilities we have loan notes, and then under current liabilities we have some trade payables. And of course, the statements of financial position for both of those companies, the top and the bottom half, are both equal and balanced. Let's have a look at the notes. So the following notes are relevant. P acquired 75% of S 2 years ago for $450,000 cash. At the date of acquisition, S retained earnings were $100,000. Right then, we can start to see the relationship then between those two companies that we saw the financial statements for. So P must be the parent company because they are buying a controlling interest in S, which would make them the subsidiary. We have control because we purchased more than 50% of their ordinary voting shares. And as such, a group would be formed. We acquired the subsidiary 2 years ago, so we'll need to think about, well, okay, if the subsidiary value is $450,000 now, 2 years ago, how much is the value of that subsidiary now, 2 years on? We'll need to establish that and see if there's any growth in the subsidiary for the group accounts. Note 2. The directors have deemed the fair value of the non-controlling interest at acquisition to be $150,000. So what we mean by that is the value of 75% of the subsidiary is $450,000. The value of the other 25% at the time that we acquired the subsidiary was $150,000. So the non-controlling interest would own the other 25% of the subsidiary, and the value of their 25% is deemed to be $150,000. So let's have a look at the requirement then. Prepare a consolidated statement of financial position for P Group as at the 31st of December 2011. So you're going to need your pro forma consolidated statement of financial position, a couple of pages back in your notes. And you'll also need to keep the key workings handy, which we didn't go through on the video, but we're going to go through now and apply it to some numbers, because it makes more sense to do it that way. It's easier to explain and easier for you guys to learn. So let's pull up then some paper, and we're going to have a look at our example, which is P Group. Okay, so the example P Group. And this is the example just after the core workings in chapter 18 of your notes. So, first thing we always do then, step 1, is to do what is known as the group structure. we need to identify the relationship between the two companies that we've been given. Now, we've been told the relationship in Note 1. Company P acquired 75% of Company S 2 years ago. So we always make a note of the date of acquisition. Now, as you can see there, that the acquiring Company P must be the parent, and therefore the investee, Company S, must be the subsidiary. It's a subsidiary because we have control, and we know we have control because we have purchased more than 50% of subsidiaries' ordinary voting shares. Now, do you remember, if we have control, a group is formed, and we draw a circle around them to show the single entity, the group. Now, because we have control, all the assets and liabilities of Company S will be consolidated and added together with Company P's assets and liabilities. At this point, it's also useful to note the non-controlling interest in Company S, what we don't own. Well, if we own 75% of Company S, the NCI would own the other 25%. Okay? And that's the first thing we always do, identify the relationship with the companies given in the question. In this case, parent and subsidiary are related. We have control, and therefore we draw a circle round them to represent the group, the single entity. The next thing we do then is, because we know that we're going to have to consolidate, because we have control, we can set up the consolidated statement of financial position and consolidate the assets and liabilities of the parent, Company P, and the subsidiary, Company S. So, step 2. Prepare the consolidated SFP and add parent and sub assets and liabilities on a line-by-line basis. Okay, so what we're going to do then is do the consolidation because we know that they are related and a group is formed. So, name of the parent is P, group, consolidated statement of financial position as at the 31st of December 2011. Okay. So we're going to do a nice heading for the statement of financial position, and we're going to write this up ourselves. You should be fairly familiar with the format, but in the question they give you the format anyway. So it's just a case of copying, really. So 2 columns. The question is working in thousands, so we shall as well. We'll start off with the heading, non-current assets. Okay, non-current assets, that's our first heading. We start off then with the first line that we've been given in the question, property, plant and equipment. And if you look at your pro forma group statement of financial position, do you remember we said that assets are under control of the parent and therefore of the group? And as such, what we do is we take the parent's PP&E and add the subsidiaries. So, can we see then in the question, if we go back to the statement of financial position, non-current assets, we're going to tick off the parent's PP&E and tick off the subsidiaries, and we're going to add them together and consolidate them. So, Parent, 1,000 plus sub 500. Leave that bracket open just in case there's any changes we need to make. There will be adjustments in the F3 exam you may need to make to any of the group's assets and liabilities. We'll see that in later sessions. Now, our next line is going to be investments. Now, do you remember that parent, Company P, paid $450,000 to acquire Company S? That was in Note 1, remember? And as such, that $450,000 in Company P's financial statements represents the cost of investment in S. That's what we paid to acquire 75% of Company S. Now, the rule is that we must cancel out the investment on consolidation and replace with the subsidiary goodwill, assets, and liabilities. Remember, that $450,000 is going to buy you two things. It's going to buy you the things, the physical assets and liabilities of the subsidiary, but it's also going to buy you the goodwill if you pay more than the book value of their net assets. Okay? So the excellence or reputation, the tangible assets and liabilities, and the intangible asset of goodwill. So we need to ignore this 450, but use it as a reminder that at that point we need to add in a working. And it's going to be a working for goodwill. Look at your pro forma. Goodwill. I'm going to put a W there because it's going to be a working. We can't do much more with that at that time. Now let's proceed then to look at current assets. Okay, current assets. And again, all assets and liabilities are under control of the group. So, we can see that we've got three lines of current assets: inventory, receivables, and bank. And we're going to take the parent's current assets and add them to the subsidiary. So we're going to tick all of those figures off. The ultimate goal is through consolidation that all the figures are going to be used from the financial statements. And you know you've used them all if you've ticked them off as you go. So, going back to our statement of financial position then, we've got inventory. Parent, which was 300, plus subsidiary of 250. We control all their assets, and that will include inventory, receivables. And whilst we're here, let's pop in bank as well. Receivables were 200 parent plus 150 sub. And then bank was 300 parent plus 200 sub. Leaving those brackets open for some various adjustments, which we'll see in later examples. That will give us total assets for the group. Okay, and that will be the top half of the SFP done. Now what we need to do then is look at equity. Okay, the equity section. So under the equity section then, what do we see? Well, we have share capital and retained earnings. So starting off with share capital then, remember that we only consolidate the parent share capital only. And that's because we're preparing the consolidated statement of financial position for the parent shareholders. And as such, they will only be interested in their investment, not theirs in the subsidiary investment. So it's always parent only for share capital, always for group accounting. So equity, share capital. In the subtotal column, we'll pop in the parent's share capital which were $500,000. Always parent only for share capital, but also for share premium as well. We'll then have retained earnings. And then do you remember from our pro forma that we saw in the last session, we have to do a working for group retained earnings. We'll see why shortly. We then subtotal at that point, bring the total across, so leave a line. We then got to remember to add in an extra line called non-controlling interest. We need to put a value to the investment in Company S that Company P does not own, the other 25%. That will always be a working, and we'll see those workings shortly. But draw a line underneath that, and that's going to give group equity. Now we proceed to consolidate the non-current and current liabilities on a line-by-line basis. So, non-current liabilities is our next heading. And if we look under non-current liabilities then, we can see that we've got parent 100 loan notes and sub $50,000 worth of loan notes. So loan notes, just like we do with assets, loan notes would be parent plus subsidiary, 100 plus 50, but don't close the brackets until we've finished the question, once we've done all our workings. Finally then, we have current liabilities. And if we look at the question, current liabilities, we had some trade payables, parent plus sub. So any assets and liabilities consolidate on a line-by-line basis. So we've got some trade payables, open a bracket up, parent plus sub, 1,000 plus 450. And then if we leave a little line, that's going to give us total equity and liabilities. There we go. So if we have an investment in a subsidiary, or the assets and liabilities of parent and sub are consolidated and added together on a line-by-line basis. And that would be step 2. Now there is a third step to doing consolidations, and that's to do your workings. And what we're going to do is we're going to have a look at the workings in the next video. So the aim of this session was to give you a feel of the structure of how we do a consolidated statement of financial position. In the next video, we'll have a look at the workings and complete this example.